Three, two, one.
Hello, hello, hello. Welcome to the Build and Grow with Real Estate Show. My name is Judah Hoover, and this right over there is Josh Weidman coming to you every day at noon. I got to tell you, man, I woke up today, even though it's a Tuesday, I was feeling a little bit like I had a case of the Mondays, dragging a little bit, having, just a lot of stuff to do today. None of it really that fun and exciting, and just And then it comes time for the Build and Grow with Real Estate Show, and I've got tons of energy, tons of optimism. I'm pumped. I'm ready to go. So
Yep.
for our dear listeners out there, we know that this show means a lot to you, and it's why we get so many likes and shares. And it's a great thing. It's a great thing for us too. How's your day going, Josh?
Man, I'm telling you, when I go into the gym in the morning, even though I get less sleep, I feel like I get way more accomplished. I'm more focused. Wednesday is my day off, my sleep day. So I slept till 6:30 today. Yeah, screwed me up. More time to relax and sleep equals less work done. But I'm focused. I'm ready to go. I got some great things happening this morning. Tons of phone calls for about an hour there. I couldn't finish a phone call before I got two other phone calls coming in. So, the market's hot. The market's really hot. You were telling me an awesome joke. Joke, whatever. Very funny joke. Jump in.
Somebody, a buyer's agent realtor, two buyer's agent realtor friends of mine were joking back and forth on Facebook about, what's it like trying to find buyers homes right now in this market. And the response was basically, do you remember what it was like at the beginning of COVID when no one could find any toilet paper and everyone was desperate to get it? It's kind of like that. That's what the buyer's market is right now.
Well, it's insane because at every level, whether it is investor grade properties or, just the nicest properties out there, you have competing bids. And in fact, the end of last week, I talked to a potential borrower. He sent me this property. Comps look really strong. The property was overvalued. It was an REO. Place was trashed, right? Good neighborhood, very consistent, all this kind of stuff. But it was overpriced, so nobody was bidding on it. He went to see it, and when he went to see it, he was like, yeah, I can't do anything with this. Too overpriced. They dropped the price by $50,000, okay? So we talk. We get him pre-approved. We get him his funding letter. He's ready to go. Goes in and bids. Saw a post on Facebook by a local agent whose bid won the bid. But the thing that people were missing here, it sold for the original asking price. Because you had so many bids on the thing.
Right.
When nobody was bidding, the bank, they had it priced too high. They dropped
the price.
And now all of a sudden they have 8 people bidding on the thing, and everybody gets into a fervor about, hey, let's get this deal.
Right.
And it gets overbid. But that plays right into our hand today with what we're going to talk about, and that is financing and new construction as a function of the market cycle. So let's start before we jump into that though. We had some questions that were unanswered yesterday.
Right, we just ran out of time, and we appreciate our questions. We appreciate our dear listeners who make comments and ask questions and like and share the show. We were talking about what happens during an economic downturn, and we've got real estate highs and lows, and there's 6 real estate cycles. And during an economic and real estate downturn, during a free fall and the bottom, do buyers get more picky? Was the question, and the answer is yes, absolutely they do. What?
Yeah, and I think what we have to do though is split that into 2 groups, right? Because maybe the comment was about retail buyers, but it could just as well be on wholesale buyers because it's relevant on that case as well. Which you want to take? You want to take retail?
Let me just talk retail buyers here really quickly. Yeah. So what causes the market cycles, or a major contributing factor, is right now construction is crazy hot. We're going to get into those numbers in a little bit. Eventually, builders overbuy, and they flood the market with too much with too much product. and that devalues real estate. And then real estate goes into a free fall. Builders stop that building, and then we reach stability on the bottom, which results in recovery. So during that free fall and that trough at the bottom, you, dear homeowner, trying to list and sell your property, or you, dear flipper, trying to buy, fix up, and sell a property, what you're competing with is a whole bunch of other inventory that's on the market. You're competing with a whole bunch of new construction homes that are out there that haven't sold. And so just like when you go to the grocery store, I was at the grocery store last week looking for avocados, and I could not find good avocados. So guess what? I was a whole lot less picky about the avocados that I wanted. But when you go to the grocery store and there's like 5 boxes there of avocados, you pick them all up and you squeeze them and you see which ones are the right ones without actually bruising them.
Analogy.
So, well, that's what happens is right now there's no avocados. So you take the 4 or 5 you can get, and it is what it is. Right now there's a bidding war for any piece of real estate that's out there and on the market right now.
Yeah. Well,
here's the other thing that happens that causes that is, remember, the same thing happens in the rental market too, where you're going to have you're gonna have a whole bunch of inventory dumped into the A class property. We've talked about class A, B, C, and D, and there's writings online about it. We're not going to go over that right now. So let's say Josh and his wife want to sell their house and move to Toledo. Well, maybe they can't sell it for the 150 that they wanted, and now the market's telling them it's only worth 140 or 135. They said, well, geez, I'll just sit on this and hold it for 2 or 3 years because I know what Judah and Josh said is that the market's going to come back. So they turn it into a rental. Well, that becomes more rental product, more rental inventory that's out there, and it dilutes the rental market a little bit. And so if you have an A-class rental in your portfolio, it's going to be harder to find A quality tenants. You might need to lower your standards a little bit and have a B move in. But all that does is delete the potential pools for the B quality people, which means they're going to have to move some C's in, and C's are going to have to move D's in. And, it all excrement rolls downhill. The D quality properties are the most negatively affected because right now obviously we're recovering from COVID and everything like that. But right now, D quality neighborhoods are doing okay. We're basically experiencing full unemployment during an economic downturn. If and when one should come, there's going to be a whole lot less people in the D quality market that are employed. And so owning D quality properties becomes very difficult during an economic downturn for a whole bunch of reasons.
Well, and all of those properties that fit into the first-time home buyers / nice rentals, right?
Right.
Now,
like your C and B quality properties.
Right. Now, there's no first-time home buyer market because as that cycle continues, and the banks, they've got an inverse relationship to value. As prices are high, they give the best rates and they're the most liberal with their lending. As things start tightening up, well, so do lending requirements. Now, nobody's offering that 3% down. You got to have a 700 credit score. You got to have skin in the game. And so what you end up with is fewer buyers for the lower end properties, and that just drags the value right down. It's only guys like us who are buying. And right. So it's only your investor buyers that are purchasing those houses, and they're looking at cash flow, and there's a glut of them on the market. So it's like, am I going to buy this one or that one? It doesn't matter because, I don't care what the layout is. I don't care how nice the crown molding is. It's what return on my investment. Right. And so that's got a huge play. Now on the wholesale end, first, by the way, I want to thank Ken there for giving us a little heart there. If you're liking what we're saying, jump in. We'd love to see your comments, and we'd love some love. So anyway, if you're a wholesaler, think about it like this: what happens when the market's hot? It happens everywhere. When you start seeing stuff on TV about getting rich in real estate, everybody runs to invest. It's human nature. We want to chase the quick buck, right? Right. Well, when that happens, it's easy to sell courses. It's easy to sell houses. It's easy to do all that kind of stuff. When the converse happens and everybody starts saying, oh my goodness, The market, the sky's falling down. This is the worst time to invest. Real estate's plummeting in value. Well, all of the newer investors, they're going to go, oh my goodness, let's get out of this house. Let's dump our properties. Even though we bought at the height of the market, we're going to sell it now before it hits the bottom. That fear is a huge motivator. And so you have a smaller pool of buyers that are going to be buying these wholesale deals. Now, as a wholesaler, you're going to get a heck of a lot more calls from motivated sellers. You're going to get a heck of a lot more people willing to sell you their property at a discount, but those discounts have to be greater because your buyers are going to be a lot more selective. When they, I mean, I don't know if you remember this, Judah, but we had Eric Brewer on here a couple of weeks ago, and he said, you know, when he was first investing, he didn't even think about marketing. Why would he market?
Right.
And it's great deals on the MLS, right? So if you're wholesaling, your value add is creating or providing a property that is an off-market deal that is well below market. Well, if the market is $25,000 for that property, how much lower can you go? Right? How much more of a discount can you get? So of course,
but as we talked about yesterday, there are some times when you want to let somebody give you a piece of real estate for free. Josh learned that lesson the hard way.
Yeah, exactly. All right. I think we thoroughly answered that question, right?
I think we did too. Yeah, I knew there was a lot of content there to get into, and I would just encourage you, if you are going to be a landlord during the downturn, just remember that you might need to give first month's half off, or you might need to have other sizzle features associated with it. If you're going to be a flipper, you're going to be competing with new construction, and you're going to need to really quite aggressively go after high-end finishes. If you are going to be a wholesaler, you are going to need to do a better job telling people what the comps are, steering people in the direction of value, making sure that people are getting a good deal. Right now, you can put a property out there as a wholesaler, and if somebody overpays, oh well, maybe they see something you didn't. But you're going to have to supply a whole lot more. Just right now, if you're a wholesaler, you're probably not giving somebody Josh's telephone number on every single wholesale package you send out. Well, you very easily and could and should. You're probably not doing a cash flow analysis on every one, whereas you could or should.
Yep. I mean, this is a great comment. Chris Gaines, he's saying, in a neighborhood, new construction neighborhood right near him, almost 100. They increased prices by almost $100,000.
Yeah,
sold half the community in a month. I mean, that's the kind of market we're in, right? Like, there's just so much demand for housing. Interest rates are so low, and we're going to look at how that plays in. So, I mean, let's jump in. I mean, Monday we started with kind of explaining the market cycle, and so today we're going to talk about how construction and financing play into that market cycle, and really often are a driver. What did you see yesterday that really jumped in?
I just saw this. I love this chart because it's very important to remember, where we are, and right now we're actually at the beginning of this chart. It's it's not always, you're not always in stage one, but we just so happen to be in. Well, we're in stage 6. We're in late stable, so we're coming up on this peak, and this peak might continue to go up a lot more. It might come down. Also, I like that market cycles are in a sine wave, but the two peaks are not necessarily the same. Sometimes the next peak is a little bit lower or a little bit above or whatever. So there's a number of different things that I really like about this chart. And I think it's important just to go over it just quickly again and refresh this in everybody's mind. So right now, we are at the late stable, which is when we're coming up on the peak. We do not know when the peak is coming. We will not know the peak until 3 to 6 months after it's already happened. But wise and studious people will be able to see it and recognize and pay attention to it while it's going on. Then comes a downturn. Then comes the bottom. Then comes the beginnings of recovery. And then there's early stable market and then a late stable market. And we are in all the indicators right now, not of an early stable market, but of a late stable market. And so we want to do as much business as we can, but also being as cautious as possible right now.
That's right. So the reason that this topic came up today is that I don't know if you saw this, but there was some numbers published earlier this week. What was it? 22%.
22%.
New
Amazing.
construction starts increased by 22% in a month.
Month over month. That's
right.
not year over year. That is month over month. So that means that builders are getting back out there aggressively. Certainly they were depressed numbers before, but it's not like the numbers got depressed and then stayed depressed. They are bouncing back in response to the housing demand. And that is a very good sign for long-term housing numbers. And that's also a very good sign for long-term economics of the United States.
That's right. All right. So what's it cost to build a house? I mean, that's a really important factor here, right? Because, but as we look at this, if you're looking at a piece of vacant land, and you're saying, all right, I want to build a house here. A lot of the calculation that goes into it is whether or not it makes sense to build a house.
And let's just do a quick timeout here, caveat. I'm never going to build a house. Josh is never going to build a house. We're not saying anybody needs to build a house. This is not a house building presentation. This is understanding the fundamentals that go into your industry so you understand how to read and understand numbers. Go.
That's right. Okay. So let's say that we have home values in a neighborhood that are $100,000. At $100,000, does it make sense to build a new construction property? The answer is, who knows? What's it cost to build a house, right? The reality is that if you are a very good spec builder and you're building one-off new construction, if you can get away with $100 a square foot for building costs, you are a rock star.
Right.
A total rock star. Okay. But there are three components that go into any construction project and the cost of a new construction property. The first is going to be the land, right? If you are buying single lots, like if you're in an urban environment like Lancaster or Philadelphia or Pittsburgh, and you have a densely populated area and you've got a lot there that you can build on and buying that one off, there are areas where you can buy land for almost nothing.
Right.
And, if you're buying those lots one off, it's going to cost you more than if you buy 100 acres and subdivide it. It just is on average price per lot. In urban environments, a lot of times what you see is that you've got a lot of development in a not so nice area, right? That drives up the houses. All of the existing homes are improved. And then you get to a certain price point where all of a sudden you see new construction popping up everywhere.
Right.
And that often happens because the price point reaches a certain point where all of a sudden it's profitable. And the nice thing about new construction investing is that the costs are a lot more predictable. They're higher, but they're also a lot more predictable. It's
right because it's not because you know exactly what you're building beforehand. It's not like, oh, this is a 3-2. Well, I wonder if it's a 3-2, that neighborhood where the 3-2 has the 1-car garage or the 2-car garage. I wonder if this is a 3-2 where they opted for the gas heat or the oil heat. I wonder if this is a 3-2 where they've had to replace, because I know it's a 20-year-old neighborhood. Some of them have had to replace the HVAC and the roofs, and some of them haven't. So the rehab cost is a lot more fluctuative.
Well, exactly. And with new construction, like you can negotiate with your builder beforehand. It's $7 a square foot for framing, as opposed to, hey, look, we've got blueprints for this reconstruction, but we didn't anticipate replacing all the beams on the second floor. Or, instead of just putting new shingles up there, we ripped the old shingles off and we found that all the decking or half the decking needs to be replaced. Like there are surprise costs that you have to anticipate with a remodel that aren't there with new construction. Okay. So you've got land value. Second, you have development costs. Typically, a builder is not going to also be a developer. Just as a rule of thumb, that's not the case. Usually developers are buying plots of land. We talked about land banking.
Yeah, explain what a developer is. That's a concept that many people are probably not familiar with.
All right, so let's say that you have a plot of land that is actually a perfect example. I went to see a guy yesterday about a small farmette. It's 11 acres, and we got into a long conversation. Here, it turns out he used to own 150 acres. And in 1987, the township said, look, now's your time to subdivide this land. If you don't subdivide it, you're not going to be able to change the use. So he goes out and he subdivides it into a bunch of smaller plots. Subdivision is one part of that process. The second part of that process is now you've got all this raw land and you've got all of these separate lots, but there's no plumbing that goes to the lots. There's no roads that get there. There's no electrical lines that, all of that stuff has to get into the land. And a lot of times when you're developing the land, you have to meet certain criteria like runoff, stormwater runoff. You gotta make sure that there are no endangered species. You got to make sure that in certain areas that there's no contamination of, oil tanks or things like that. So a lot of the development is just getting ready to build, right? Just getting the place ready to go. Those costs can be fairly inexpensive because a lot of times developers will choose areas where the township has a development plan to increase their tax base. And in those type of things, the township may bear some of that cost. You still got to move the dirt around. You still have to build the roads, but maybe they say, all right, we're going to help with running the electrical lines or the plumbing or the gas lines. In other areas, just to get a subdivision, the township may require you to run all of the plumbing lines, all of the waste lines, all of the things that you're going to need even before they'll grant the subdivision. And you can be talking $50,000 to $75,000 in costs right up front for one additional lot if you're splitting your lot in half. So, I mean, you really have to do some research on that. And then, the developers are often very well compensated, right?
Yes.
They are. Yeah. I mean, there's a
the ROI on development is huge.
It's huge because you're dealing with huge numbers. You've got really, really big numbers that you have to deal with. You're not going to develop, a 100-unit community, for $100,000. You're talking 7-8 figures to do that kind of development. The last piece here are your construction costs. And again, if you're doing one-off construction and you are a rock star, $100 a square foot is a great price. I've seen numbers as high as $300 or $400 a square foot in some higher end urban markets for like the high end development. Reasonably, you can expect $100 to $200 a square foot. But these large developers and the large builders that are building communities, here's why it's so attractive to them. They're able to get in there and build for like $50 or $75 a square foot because they're offering their framers framing 100 houses, electricians, 100 houses. You've got a real volume discount there that these builders or the actual contractors can take to their vendors and say, look, I need 100,000 or a million square feet of siding. Like that, you're going to be able to get a good price on that. And so
because they're also going to be able to get a good price from their suppliers as well.
That's right. Exactly. So when you're looking at how this plays in, you've got to reach a certain threshold. You will likely see in suburb and urban or in rural markets a lower price point for large community development. A need for a lower price point in larger community development than you will see in urban environments where houses might sell for $50,000 to $100,000 more for new construction, but to get the area to a point where it makes sense on a one-off basis can be a lot more difficult. Okay, all right. So that's the first part of this. Second part of this, of these driving factors when it comes to interest rates and financing and how it plays in, is your interest rates. I mean, right now, we're at 2.99%. I think I said this before. The mortgage on my first house was at 6.25%, and I thought we got a great number at that. If you are buying a $250,000 house today, or I'm sorry, if you're getting a loan for
$250,000,
right, and you figure 1.5% for taxes, it's going to be a little bit lower, a little higher, but let's say 1.5%, and you have a $1,500 insurance policy. If you have a 2.99% mortgage rate, you're looking at $1,500 a month for $250,000. That's great. That is phenomenal. And I base this on a 2,500 square foot house because that's the average across the country and what we're seeing on numbers. But you look back in recent history, as like when I was a 2-year-old in the early 1980s, 12% mortgage rates, they weren't unheard of.
Correct.
That was par for the course. For that same house in the 1980s, you're talking about $3,000 a month. I mean, more than double the cost for the same amount, to borrow the same amount of money, same 30-year term, same taxes and insurance. Like that's a significantly different, affordability ratio. If you are, you're paying $3,000 as opposed to $1,500 a month.
Right. So a large portion of what is driving the value increase that we're seeing right now is the decrease in interest rates.
Right. And because we've seen that value increase as it has, it becomes a heck of a lot more attractive as a builder to say, you know what, let's jump in here and build these houses. I mean, we got demand. What's the current, how many months of inventory are currently on the market? Do you know?
Oh my goodness, I think it's like 2 or 3. I mean, it's crazy low. I mean, it might be under 2. We might in all of Lancaster County, there's only 400 houses on the market right now.
Well, that was yesterday.
Yeah.
Today it might be down to 100. That's what I'm saying. Like things are moving so quickly. It's on a day-by-day basis almost.
Right.
What the inventory looks like. So you're talking about a few months of inventory, and 6 months is typically a balanced market.
Right. 5 to 6 months is where people would say is a balanced market. More than that is what's called a buyer's market. That gets back to Steve's question, what we were talking about at the beginning of the show, where buyers have more of the power, where buyers can be fussy, where buyers can be picky, where buyers are going to ask for sellers' assistance and sellers' concessions and make their offers at a discount. Balanced market is a balanced market. Right now, we are in a white hot seller's market where the sellers dictate the terms and the sellers dictate what they are willing to accept and not willing to accept.
Yeah.
So anything under 3 months, anything under 4 months is very much a seller's market. That doesn't mean the average house lasts that long on the market. That means that if there were no more houses coming on the market, how long at the current pace would it take to sell through what we have? And it's kind of crazy what's going on right now.
Well, and I think it's going to be interesting with that type of demand and lack of inventory. Even though I've been fairly pessimistic on the housing futures and things like that, I still think there's a downturn coming. And as we look at the cycle, I think we can all agree that those things will happen. But I think it's also realistic to say, I don't think it happens tomorrow. I mean,
no,
I think it's unrealistic to say, September, October, November. We've got an election coming up in November. That's going to be a big tell on where the markets are going to go. I've seen a lot more news about new sellers entering the marketplace, but it makes me wonder. I thought last year we had record highs. I thought last year's spring market and into the summer was ridiculous high markets. How much higher can this go? And
right.
I think it's based on inventory. I think it's going to take.
I think we have more room to go up. I really do. I do not see anything, especially when I see that interest rates have more room to go down, and people are like, "What are you talking about? Due to the 3%?" When you look globally at what interest rates are, the interest rates in the United States are high and could continue to go down.
Well,
so, Josh, we've got a pretty good guest coming on the show tomorrow. So Thursdays we always interview somebody, and this is somebody who you and I both know, like, and trust. We've got Jason Sanseverino coming on. He is a short sale expert, and what's so great about the short sale marketplace is it's something that never goes away. There's always a space in the marketplace for it, and at times like this in the market, you really want an expert working for you. And so Jason doesn't pay us anything to do all this. And, I just want him on because he's an expert at what he does and an expert. He's seen several of these cycles. Jason's an old dog like I am. He's seen a few hunts in his day. So what Jason's going to be able to talk about is what's going on right now. And the short sale market is different today than it was 10 years ago.
Sure.
And I want to talk to, and I want to get advice from somebody that is currently actively and aggressively doing them and knows what's going on and what's happening.
What? And he's doing a short sale for me right now. I mean, we're in the midst of it right now. We should hear something back from the bank in the next month or so. But I mean, I've been completely impressed with his team and like his responsiveness and communication. So I mean, like, this isn't a sales pitch for Jason, but you know, if you're going to work with somebody on a short sale, he's the guy to do it.
Yeah.
Anyway, so he'll be there tomorrow. Judah, why don't you take us out? Tell us a little bit about how people can get in touch with you. And
my name is Judah Hoover, and I want to be your realtor. You can reach me at 717-766-7994. I'm over here with Slate House Group. We are a modern real estate company. I am getting ready to list another house today for somebody else that is a real estate investor. And I work with homeowners and I work with real estate investors, both equally, and would love to work with you as well.
That's right. And my name is Josh Weidman with Hard Money Bankers. I mean, you already knew that. We introduced ourselves at the beginning of the show, but I'm a hard money lender. Hard Money Bankers, we've been loaning since 2007. If you're looking for funding on your next project, give me a call. We are lightning fast because we're a direct lender. We're able to underwrite your deal, get you approved the same day, and then fund within 24 hours if all your paperwork is in order and title work is done. So, yeah, great day today. Thank you so much, Jeremy, Anthony, Robert, Noah, and Ken, for your love there. If you like what you saw today, give us a like and a share. Be back here tomorrow at noon. We got a lot of great content with Jason on tomorrow. All right.
See everybody.
Thanks, guys.